Welcome to Idea to IPO. Hello, my name is Rob. I organize Idea to IPO. We've been doing events in Silicon Valley for many, many years. We launched officially on February 1st, 2010. At that time, we had no members and no events on our calendar. At this stage, we have over 100,000 members among all our meetup groups all around the world. We've organized, promoted, and produced over 2,436 events. By any standard, by any measure, we're the most active, most prolific startup event organization in the history of Silicon Valley, bar none. We organize venture capital panels, legal workshops, networking events, and more. These days, we're 100% online. We have an event nearly every day of the week. Check out our schedule at ideatoipo.com. Our featured speaker tonight is one of the top startup and venture capital attorneys in Silicon Valley, and he is passionate about helping entrepreneurs succeed. Ladies and gentlemen, Roger Royse. Roger, take it away.
Okay, thanks, Rob. Hello, everybody. Our international audience, my name is Roger Royse. I am a partner with the international law firm of Haynes & Boone, and I'm based in Palo Alto, California, heart of Silicon Valley. I see, well, we have a lot of people tuning in tonight. That's great. I hope a lot of you are back from how to prepare for venture capital investment part 1. Tonight, we're going to have, you guessed it, part 2. And we're going to get into a little more substance tonight, a little bit more, a little bit meatier. Last week or 2 weeks ago when we did this first one, the topics were a little softer. Now we're going to get down to the nuts and bolts of this. So a couple of things before we get going. Number one, I'm going to talk for an hour, then I'm going to take questions. So at the top of the hour, we'll go to questions. You'll ask me questions by typing them in the Q&A box at the bottom of your screen. That's questions and answer. You do the questions, I'll do the answers. That's how this works. Don't type that in the chat box. If you got, I'm not going to look at the chat. I'll look at the chat box, but I'd rather the questions be in the Q&A box. Chat me if there's something I need to know about right away, okay? If I forgot to comb my hair or something. But substantive VC question, put that in the Q&A box. Now, I do a lot of these for Idea to IPO. Thank you, Idea to IPO, for hosting this and for managing this. I'm your speaker and your moderator quite often, and we have a full calendar, and you can go to the Idea to IPO website, the Idea to IPO YouTube page, or the Roger Royse Law YouTube page, and you will find videos, probably about a dozen of them from this year at least, on topics venture capital related. You'll find this presentation recorded and posted on my YouTube page. You'll also find these slides on SlideShare, but you're also going to get a link if you signed up and registered for this event after this is over, so you can watch this over and over again if you want to. We do this every couple of weeks. Did I hear somebody laugh? We do this every couple of weeks. I haven't even gotten to the good stuff yet. Do this every couple of weeks. We're going to have more panels and presentations coming on through the rest of the year. We hope to do media tech. We hope to do construction tech. We hope to do a lot more substantive legal panels. Now, before we get going, I do want to find out who is here with me in the audience. So I am sending a poll. Yes, but would all the panelists please mute themselves? Everyone but me. Okay, the poll is who's in the audience? How many startup entrepreneurs do we have? How many investors do we have? How many service providers like me? Are you a techie? Are you in education or academia? Are you in government? Anybody from the press? Any of you pesky paparazzi out there? All right, that's good to know. And then, of course, some of you will be from more established companies. I guess you're just here for general interest, or maybe you're thinking of making a career change. Right now, we're running at 70% startup entrepreneurs. You know what? I forgot to ask how many, investors. Not so many investors, 4% investors, mostly startup entrepreneurs. Several of you identify as techies, some of you as service providers. Okay, that is 1 minute. I'm going to end the polling. But you know what? I'm really nosy and I'm not done. So I'd like to know where y'all are from. Are you from Silicon Valley? Are you from other parts of the United States, Canada, or Mexico? Um, anyone from Western Europe? What time is it in Western Europe? Probably in the middle of the night there. So that's no excuse. You should still get up to listen to this. Eastern Europe, Russia, Asia. We've got 9% Asia. We've got 41% Silicon Valley. And oh, look, 35% from other US, Canada, and Mexico. So this is a largely North American crowd. Africa, 4% Africa. Wow, we actually got India and Asia. We got a pretty good international audience here. I'm going to let this stay open. 80% have voted so far. And looks like it is about half Silicon Valley, about 30% other North America, and the rest is Asia and India primarily. Well, alrighty then. So those are the polling results. Now I know who we got. I want to let you know that we're streaming this event live tonight. We're streaming to Facebook. So this event is being shared all over the world to anybody who happens to be able to find my Facebook page. I would be streaming to YouTube if I knew how. So if any of you brilliant technologists out there know how, just text me. Put that one can go in the chat because I would like to put it on YouTube. I just can't figure out how to do it. Anyway, now comes the most difficult part of the evening when I have to share my screen and go to my slides. So you should be seeing my slides. If you're not seeing my slides, please chat me. Okay? If you are seeing my slides, please chat me. Is anyone out there? Anyone seeing my slides? Can see. Okay, thank you. Thank you, thank you, thank you. That means that you can now, I did about 20 minutes of this one time and nobody could see any of my slides and everyone was too shy to tell me. So that's why I asked. Okay, how to prepare for venture capital investment, part 2. This is the cover slide. I want to let you know, first of all, because I am a lawyer, you're not going to get legal advice here tonight. You're going to get awesome advice, but it's not legal advice. So I'm not sure. I am a lawyer. I'm not sure a lawyer, at least not yet. You play your cards right. We could change that. But for today, we're here about how to learn how to prepare for venture capital, part 2. This is a picture of a venture capitalist. Oh, wait, I'm sorry. That's a shark. How did that get in there? Darn. Let me move right along here. I don't want to offend anybody. So we ended the last time that we did this, we were talking about vesting. You may recall we said, what's a VC going to want to see in terms of vesting? And we talked about good corporate practice. Who should vest? Pretty much every service provider in your company should vest. How long should they vest? What about acceleration? Remember what acceleration is? Remember how long they should vest? Remember what we said? Founders, usually 3 or 4 years. Everybody else, rank and file, usually 4 to 5 years. Advisors, usually 2 years. With a cliff, remember what a cliff is? You got to work for a year before you get any vesting. And remember what vesting is. That's the idea that you earn into your shares and you have to sell them back at cost, which is, usually what we call a peppercorn in the law. You have to sell them back at cost when you leave the company, your unvested shares. So vesting is really important. We talked about acceleration, if you remember. That's where we ended. We said sometimes people will say, well, gee, if you sell the company, well, I'm unvested, I should 100% immediately vest so that I'm fully vested in the consideration and the sale, whatever we got for the company. We talked about acceleration on termination without cause. Sometimes founders will say, well, if there's 3 of us founders and 2 of you guys get together and fire me, you gang up on me, and I didn't do anything wrong, I wasn't coming to work drunk or anything, it's just, you just got together on me and, you threw me out just to take my shares back, I should get accelerated vesting. That's vesting on termination without cause. Either one of those is called a single trigger. It only takes 1 trigger. Double trigger is when both of those things have to happen within close proximity of each other. So you typically have either or both of a single trigger or you have a double trigger. Hardly ever do I see a single trigger. Often requested, rarely granted. Why is that? Well, because VCs hate those. So that's number one, you should know. So for the founders and the C-level people, the executives, it's fair to ask for double trigger vesting. For everybody else in your option plan, you don't want to have any accelerated vesting. It messes up your plan. It takes all the value away from it. And the VCs will view it that way. They're not even going to like giving you double trigger vesting, but they might go along with it if you're valuable enough. Now, let's kind of drill down into some more interesting stuff about vesting. So when I started practicing law, it was, God, I think Joe Biden had only been a senator about 50 years at that time. So it was a long time ago. Things were different. Companies used to go public within 4 years. They all thought they were going to go public within a year. But it usually took about 4 years if they went at all. So people figured, well, 4 or 5 year vesting makes a lot of sense for the founders, right? Because that's how long it's going to take to keep these guys engaged until we can go public. Well, I'll tell you, things have changed a lot since then. Companies don't go public that often. I guess this year is different because we got this thing called a SPAC. Actually, that ought to be our next presentation on SPACs, but I get ahead of myself. But other than SPACs, which is a reverse merger into a public shell, other than those sorts of things, generally we view as companies not going public that quickly or that often anymore. And if they do, on average, it's taken about twice as long. So because of that, remember what I just said about 4-year vesting for founders. You should consider that a cruel joke because it's only 4 years until the VC puts money in your company and makes you go back to square one and start to revest again for another 4 years because they need to keep you around until they can exit. So you ought to plan on vesting for a long time. I'll just warn you right now. Don't get too tied to whatever vesting period is in your agreement when you form the company. Expect to renegotiate that. We regularly do. Now, sometimes we do what I like to call preemptive vesting. We're about to go talk to the venture capitalists. So we'll just put something reasonable in the documents now. We'll give you a year credit and another 2 years to go or something like that. And maybe the VC, because they got to pick their battles when they come to fight with you. And they're going on their list. There's valuation, there's control, there's ownership, there's all this stuff. There's vesting. Close enough. We'll let him get away with that. He's a little greedy. He's a little piggish, but he's not hoggish, right? And you know what they say, hogs get slaughtered, but pigs get fat. So we'd be a little piggish about it on the front end and maybe they leave you alone. If you're not, they're going to ask you to revest and they might anyway. The other thing to keep in mind on the VC's view of vesting is a fund life can be 7 to 10 years, even longer. They might not exit until the end of that life. They need to keep you along for the life of the fund. Most exits are M&A. They need to keep you around until they can do an M&A, and they really need you to be there in the M&A, right? They're going to need you to transition into the acquiring company in that M&A transaction. And if you're 100% vested when that M&A deal comes around, guess what they have to do? They got to give you more stock to incentivize you to help transition the company for the acquirer. And that's very expensive because that stock's got to come out of somebody's pocket. Got to come from somewhere, right? We're not the federal government. We can't print money. They do print up new stock. It's going to dilute the venture capitalists. So the way we avoid that is having you be at least partially unvested at the time we get to that M&A exit. Here's another thing we're seeing a lot of, and I just hate this. Extended option exercise periods. What do I mean by that? So the way vesting works usually is that with option plans, you know what an option is? An option is a right to buy stock at a certain price. They call that the strike price. It's got to be fair market value when the option's granted. I know you probably all know this, but I'm going to tell you anyway because I like to hear the sound of it. So if the stock is worth $1 a share when you join a company, you get an option. You have a right to buy the stock for $1 a share. So 2 years from now, when you leave the company, the stock's worth $2 a share. You exercise that option. You got your $2 stock for $1. Better yet, if the company sells while you're still employed there, you get the spread, $2 minus $1. You just cash out the option. You didn't have to come out of pocket at all, and you got $1 a share. Didn't cost you anything. All you had to do was stick around for a while. You didn't have to. You became a VC yourself without putting any money in because you got stock in the deal. It's a pretty sweet deal, right? The way option plans work is that you have a certain amount of time after your termination of employment in order to exercise your option, usually 90 days, okay, sometimes 30. So you get to the termination of your employment, you've got all these options. Let's say you're fully vested in all your options, you've been there 4 or 5 years. Now you've got a certain period of time to exercise. What does exercise means? It means you buy the stock. You pay the exercise price, you give them your cash, they give you the certificates, or these days probably a digital certificate. Now you own the stock. Well, you might not have that much cash. Plus you might have a tax event on that exercise. And 90 days is not really a long time. So what we're seeing more and more these days is companies are saying, look, we're going to give you a year to exercise. We're going to give you 2 years, stuff like that. I don't like that. I really don't like that. I encourage companies not to do it because I don't like to see all that overhang. I don't like to see so many options hanging out there because to me, I think it messes up. First of all, it creates dilution. Dilutes the other founders, the people that are going to stick around and be with the company when you actually do sell. And that's the whole point of the option plan anyway. And plus, you don't know if that option is going to be exercised or not. And eventually, because you're getting dinged for it, because the market and the VCs value your company as though the options have been exercised. They value it's called a fully diluted basis. So even though somebody hasn't put anything into your company, they're treated as owning shares, and that dilutes your ownership. So I don't like seeing it, but we're seeing it more and more. Acceleration we talked about. And then there's a thing called a clawback that I see pop up every once in a while. That's the idea that you lose everything, or your exercisability terminates immediately upon being fired for some bad boy thing. And bad boy is something like fraud involving a felony involving dishonesty, fraud involving a company, something usually pretty bad affecting a company. We see clawbacks sometimes where even shares that you thought were vested can be returned to the company because you did something under one of these clawbacks. I was about to make a political joke there, but Rob says I shouldn't do that, so I'm not going to. Class F super voting stock. Class F super voting stock. This is something else that we hear a lot about that we see in cap tables, in capitalization. This is something else I don't like. And it's not because I'm lazy. It's not because I don't like to draft it, because it's super easy to draft. It's just that, number one, I think you're going to lose it anyway. I think it's going to be negotiated away. And I know what you're saying. You're going to say, well, Facebook didn't lose it. Zuckerman's got Class F stock. And Google's got it, and Snap's got dual class voting stock, and they went public. Well, if you're Zuckerman, then you are allowed, or Zuckerberg, then you're allowed to tell me that I'm wrong, and you can have your Class F stock. And if you're a founder of Google or a founder of Snap, then you're right and I'm wrong. But if you're not, I think your later investors are not going to want you to have that much power in the company. And we're going to talk more about that later. What is Class F super voting stock? It's a special class of common stock. It has super voting rights. So for example, the way I usually see it is we have class of common has 1 share, 1 vote per share. Then we have Class F stock that has maybe 10 votes per share. So the Class F stock, or whatever you want to call it, shares are owned by the founder, so he knows he will always have enough votes to control the vote of the common. I suggest you don't do it. I think it's just going to get negotiated away. It's just a lot of, and why is that a problem? Because you've been doing all this planning with your Excel spreadsheets based on your Class F stock, and then it comes time when you want to use it and you don't have it. Oh, shoot, I jumped ahead, didn't I? All right. Transfer restrictions. I want to pause on this. This isn't as boring as it sounds. So your shares, and what we're talking about is how you're setting your company up when you go to approach the VCs. And one of the things that you're going to have in your capital structure, assuming you've been properly advised, is you're going to have a lot of transfer restrictions because you don't want everybody who has your shares to be out doing whatever they want to do with their shares. So what are transfer restrictions? So this is, well, let me just put it to you this way, because I know what you're thinking. You're thinking, boy, that's a lot of words. That's a lot of different rights. How about, and I see this from time to time, we just make everybody agree. We put it in the bylaws. We just make everybody agree that you can't transfer your shares in the company, even though you're a founder, at all, unless you get the consent of the company, or maybe even the other founders. If you don't, you can't sell them to anybody. You can't give them away. You can't sell them. You can't die and transfer them to somebody. You can't go bankrupt and transfer them to a trustee. You can't do it unless you get our consent. Well, we can't do that. I don't think we can do that. I learned in law school that that's an unlawful restraint on alienation, and a court won't enforce it, because if you can keep someone from transferring something, that's inconsistent with saying that they own that something. So we're concerned about that. We're worried about that. It might not work. So because of that, instead, we just make it really difficult to transfer shares. How do we do that? Right of first refusal. You've heard of the ROFR. You're going to hear about it a lot. Right of first refusal means, okay, Mr. Founder, you want to sell your shares to private equity fund, you go right ahead, but you got to offer it to the company first. And if the company doesn't want it, then you got to offer it to the other investors. Okay. That's a right of first refusal. Why is that such a big deal? Because that third party buyer, that potential purchaser, they're going to know you got a ROFR, and they're going to say, why am I going to go to all the trouble to due diligence your company and make an offer and value your shares when the company's just going to buy them back? And if the company doesn't buy them back, the other investors will buy it. And if other investors don't buy it, maybe it's not such a good deal. So it really, really chills any sorts of sales. Usually doesn't stop inside deals, but otherwise it's going to chill a deal. You should have that in your shares. You just got to have that. You got to be able to control it. Why you as a founder or co-founder for a company, if you're the company, and I'm usually company counsel. Why do I tell a company they have to have that? Because you need to know who's got your shares. You know, in other words, you don't want a competitor buying up your shares, etc. Or there's other people you might not want to have buy your shares. The way you control who has your shares is through a ROFR. So you're going to have a ROFR. The VCs all understand this. In fact, they're going to impose their own ROFR once they invest in you. It's going to be a little different, but same idea. Lockups, that just means if the company goes public, you are restricted from selling your shares into the public market for a period of time, whatever the investment bankers tell you, usually 6 months. Co-sale rights, that's the idea that if you do find a buyer for your shares and you go through the ROFR, but the company doesn't want them and the other investors don't want them, they now have the right to participate in that sale with you. So buyer now is going to buy, I don't know, half of your shares and half of your co-founder shares. That's a co-sale right. They get to tag along. Sometimes call it a tag along right. The opposite of a drag along. Sometimes VCs will often negotiate for this. We'll talk a little bit more about this later. It's getting to be a little arcane, but that's the idea that one seller can force other shareholders to participate in a sale. So they found a buyer, and not only do they want to sell their shares, they want to sell your shares to that buyer too, because the buyer doesn't want just my shares, he wants all of our shares. Drag along is a right to force you to sell. That happens as a matter of law in mergers anyway. What people really use drag alongs for is they think that it waives appraisal rights or dissenters' rights. There's actually fairly recent Delaware case law that says not so fast, maybe not. So I wouldn't count on it for that purpose, but we still see drag alongs in every deal. Buy-sell provisions. I wrote a whole long post on why buy-sells are dead in startups. That's the idea that the company can buy back your vested shares at fair market value on the occurrence of a trigger, like you die, or you quit, or you're disabled, or something, or you go bankrupt. It's not that significant in a startup. You see them in every closely held company. Startups, not so much. And the reason why is because the shares aren't worth that much anyway, until something big happens. And then you got a whole new master imposing restrictions on you. And Rule 144 is a statutory securities lockup on your shares. It requires you to hold them for a period of time after you acquire them. Okay, we need to keep moving more quickly here. The other thing that you're going to do before you get to see the VC is you're going to raise a little bit of money, or you're going to raise some angel money. Last time we talked, remember, we talked about the stages of financing. We talked about founder financing. We talked about friends and family. We talked about that uncle you're going to borrow money from and hope you don't have an awkward Thanksgiving dinner with a year from now while you're sitting 6 feet away from him wearing a mask. putting your mask on between bites. It's not awkward enough. Now you got to explain why his investment did do so well. And then you get to angels, then you get to VCs typically. It doesn't always have to work that way. You can go right to VCs. If you're a wonder kid and you've done this before, you can go in with a pitch deck. Believe it or not, I still see that. But you're probably not going to be that guy or that gal. So instead, you're going to do kind of the usual run up before the VCs. So you're going to sell something to the early investors. What are you going to sell them? It used to be we sold them convertible debt. Those are notes. I borrowed money in that note, and I gave a promissory note, and the holder of the note was able to convert the note into stock, into the same stock that the VC was going to get, or into a shadow preferred stock, meaning that it's a preferred stock that's very similar, except for the liquidation preference. That's given way. We do all SAFEs these days. SAFE is a simple agreement for future equity. I could introduce you to a dozen people who claim to have invented it, including me, because I did these 20 years ago. I just wasn't cool enough to call it a SAFE. I called it something else. But anyway, I'll give the credit to the people that were clever enough to name it. What it is, it's like a convertible note, but it's equity, right? In other words, it never gets repaid. It only converts, or nothing happens to it. It doesn't pay interest. All right, that's the big difference. Now, let me tell you two more things about this, and then I want to tell you what not to do, what to watch out for. There's usually a discount, meaning that you get in early, so your $10,000 your $8,000 is going to buy $10,000 worth of preferred stock. You get a 20% discount because you saw the future, you were in early, and everybody's okay with that. Discount rate is usually around 20%. Depending on the market, it'll vary between 10 and 30, and depending on the company. The other thing is a valuation cap. So what happens if you put $10,000 in the company and some smooth talking slick lawyer talked you into taking a SAFE instead of taking a percentage of the company, instead of doing what we call a priced round? And if you had taken a percentage of the company, your $10,000 might have bought, say it's $100,000, your $10,000 would have bought 1% because it was worth $10 million. Now the company's exploded in value, and your $100,000, when it converts, it's not going to get 1%, it's going to get 0.1%. And they did it with your money. They screwed you with your money. They built it all up. Well, that's not fair. So we put a valuation cap, and we said, look, my $100,000, no matter what happens, it's going to get at least a minimum percentage of the company. That's a valuation cap. So we say it's a $10 million valuation cap. It's a $100,000 SAFE. I know no matter what happens, I'm going to get at least 1%. If the financing's at a higher valuation, I'll get my 1%. If it's at a lower valuation, I'll get even more. It's like a ratchet. So those are the two things. Then there are other terms. Usually if there's a sale of the company, the investors can convert their SAFE to common, or they can get a multiple of their money back. I'm going to go through some SAFE examples in a minute, probably longer than a minute, and tell you what to watch out for. So just kind of put a pin in that one for right now, because I want to finish going through the cap table and what's on your cap table. And if you have questions, put them in the Q&A box. And I am going to answer your questions in about 30 minutes. All right, the cap table. You're going to have a cap table when you go to see the venture capitalist. You're going to have all this stuff on it. You're going to have the SAFEs, the convertibles. You might have some warrants. What's a warrant? It's a right to buy stock at a certain price. You give those to your landlord, to your vendors, to your babysitter, whatever. Anybody who gave you a deal because you're a struggling startup and you didn't have any cash. You may have some early preferred stock. I see startup companies, they'll do a priced round early on. You're going to have options. We talked about options. That's what you use to reward your service providers. So what is all that going to look like? God, I hope this works. All right. You can't see my cap table, can you? Hold on here. I'm going to have to step out of character for a second because I definitely want you to be able to see. There we go. You should be looking now at an Excel spreadsheet with a cap table. I can see it. Okay, thank you. If you don't see an Excel sheet, chat me. This is a typical cap table. In this particular company, 20 million are authorized. Common stock, 10 million are authorized. That's pretty standard stuff. We've got Series A issued and authorized, we have none issued and outstanding. No, actually, these are all zeros. But if this were a real cap table with real numbers, we would kind of link to all our common stockholders here. We'd have their number of shares, their percentages. We'd have our Series A here. We'd have our entire stock option plan here. Options authorized, options outstanding, options exercised. We'd have our warrants on another page. It would all tie back to this one page. So at a glance, you can see who owns your company. Can I zoom in a bit? I wish I could. I wish I were that clever. All right, so I am going to now go back to hold on a second here. There we go. Awesome. All right, I'm not going to do that again. Anyway, that's what a cap table looks like. Here's another example of a cap table. You should be looking at that's zoomed in a bit because I know some of you wanted me to do that. Here's another cap table that might be a little bit easier to see. Here's an example. In this particular cap table, all we're trying to do is understand where you are on a fully diluted basis and an undiluted issued basis. And the reason I put this up here is because it's worth pausing on, because you need to do this. You need to go through this exercise and you need to pencil this out on an Excel spreadsheet and do your what ifs. What if we sell a bunch of safes that convert at this capitalization? What's that going to do to my cap table? How many shares, what percentage am I going to have? Because the mistake that people make is that they end up selling all these convertibles, which, remember what I said, they convert at some future value. So you sell a convertible promissory note or a safe, other than the cap, the valuation cap, you don't really know how much of your company you've given away. You won't know unless it's what they call a post-money safe. We'll talk about that later. But generally, you're not really going to know, especially with a pre-money convertible. So you have to make some guesses and do some estimates and do some pro forma cap tables from time to time. Why is that important? Because when you do get to that financing event, I've seen people make this mistake over and over. You've sold too much of your company. You've given too much of it away at too low a value, at too low a valuation cap. What do I mean by that? Well, close this screen and move to this one. Here's the valuation cap. You should be seeing a screen that says effective valuation caps. So typically there's pre-money and post-money safes, right? So I just want to pause on this for a second. So pre-money safe, that means, let's say you have a super simple cap table. Founders have 4 million shares, right? And there's no options outstanding. We sell a $1 million pre-money safe for a $4 million pre-money valuation cap. That means the safe is going to take 1 million over 5 million when it converts. That's what we call pre-money. Why am I spending so much time on this? It's so obvious. Well, because there's a world of difference, because most of the safes that are out there running around in the public that you can download are post-money safes. And those are way different. Those don't convert into, it's not based on a percentage based on the pre-money, it's based on the post-money. So in my prior example, that $1 million, if that's a $4 million post-money valuation, if it's a post-money safe, that means my $1 million converts into 25% of the company, not 20%. The advantage of it is that the parties know exactly what they're going to get, because with a pre-money safe, what if you go out and you sell a whole bunch of them? And they're all pre-money. So now my 1 million is not 1 million. Say I sell two $1 million safes on a 4 million pre-money valuation. Now my $1 million safe converts into 1 over 6, right? 1 million over 6 million. That's the post-money value. That's not 20%. You don't know what it's going to be until you see all of the safes that are sold. So that creates a problem, because you don't really know how much of your company you're giving away. I don't want to spend a lot of time on this. All I want to say is that the pre-money is company friendly, except you don't know. The post-money is investor friendly, because you, the founder, are taking all the dilution. They're going to get their X percentage on the back end. And those other safes are not going to dilute to the investor. They're going to dilute you, the founder. But the advantage is at least you know what you've sold. I have a strong preference for the pre-money. I don't think the post-money makes any sense at all, for lots of reasons we could talk about. I'm going to skip this because the last spreadsheet was so clunky, but when you get the slides, you'll get an example of a seed financing spreadsheet that goes through exactly this analysis. Where are we on a pre-money? Where are we on a post-money? What's it going to look like if we sell this many safes and we have this much of an option pool, etc. Do that before you go see the VCs, so you know what it is that you're giving away. Holy cow, we haven't, 7:36, we haven't even gotten into the terms yet, but I'm still setting the stage for preparing your company for venture capital. Diligence issues, take care of this on the front end. I won't go through all of this, but we'll go through a couple of things. Most of my clients are technology companies. Intellectual property rights are super important. Patents might be important to your company. Patent early and patent often. I believe in patents. I think companies get valued higher based on good patents. And it's so easy. You can buy yourself a year by filing a provisional. Talk to a patent lawyer. Make sure you got all your invention assignments in order. You know what an invention assignment is? That's that document you get everybody who touches your tech to sign that say, it's all yours, company. You know, you're paying me, but I'm giving you all my rights in that technology. If you don't have that invention assignment, you have to worry that they might come along down the road, like on the eve of your financing, and say, hey, remember me? I own part of that technology. I worked on it and you didn't get an assignment. Don't let this happen to you. Happens to companies all the time. I could tell you stories, and it's nobody's fault when it does, by the way. It just happens all the time that you didn't expect that person to be contributing IP. You didn't expect that they would, you know, tell you they signed and not sign, whatever. Employment claims, this is a humongous issue in California right now. If you were with us last month, I talked about running a startup in a downturn, and I talked about employment claims and employment tax claims. And this is an area that will tank a company faster than you can believe it. And the problem here is, as startup culture is that no one's an employee. You're working for equity. You're living on top ramen. You're not getting a paycheck. You want a paycheck, go across the street and work for Google. You know, around here, you're betting on the upside and you're going to save the world, right? So that's not how the law treats it. The law treats, especially in California, the law treats, you know, a lot more people as employees than you might think. We did quite a bit on this 2 weeks ago. Look it up online. You'll see what the distinctions are. But you need to analyze this. You need to do an analysis as to whether you are properly classifying your people, your service providers, as employees or as contractors. And for those of you who have heard me before, you know that HomeJoy is my poster child for getting this wrong. HomeJoy raised $10 million in venture capital, and they could not raise a Series B because of this issue, because of solely this issue. That's what the CEO said. Said we had to close our doors because the VCs wouldn't touch it once we got that one class action lawsuit because of employment misclassification. HomeJoy was a platform company squarely in the sights of California AB5. For those of you who follow politics, it is squarely within the law, and they went down in flames. Regulatory, make sure your regulatory is up to speed, that you're not doing something illegal. You'd be surprised some of the ideas that come across my desk, some of the things people think they can do, not even in the United States. So check with a lawyer before you get engaged in a business. And by the way, this is really subtle. If you think about it, you know, I know we were just talking about platform companies. If Airbnb and Uber and Lyft and probably a million other successful companies had been regulated, they never would have come into existence. And maybe they were regulated and just didn't believe they were regulated, so they pushed that envelope. So that's a good way of dealing with regulation. A bad way is the company that might do something that's just flatly illegal. So it's a subtle distinction. Talk to a lawyer. Litigation, we talked about that last time. Claims by a prior employer, entrenched management. We have a whole hour that we do on this sort of stuff. Due diligence. Make sure your company is clean as a houndstooth before you talk to the VC. Mistakes are free before you get into that conference room. They're going to cost you valuation points or maybe your whole deal if the venture capitalist has to tell you that you've got a diligence problem because you did something wrong. Okay, we're getting there. Hang in there with me. Stage financings. I don't believe I have to say this, but I do. I have to tell people because quite often, people come in my office and they say, you know, phooey on this founder money, friends and family money, rich uncle money, and angel money. I'm just going to value my company at $50 million and go take $10 million directly from the VC. Okay, there's three things wrong with that. Number one, no, you're not. Those are not going to give that to you. Number two, if they are silly enough to give you $10 million, it's not going to be at a $50 million valuation. You haven't done anything yet. They're going to give it to you at a very low valuation and take away most of your company. And I've actually forgotten what the third was, but those two ought to be enough. So what you want is you want to raise enough money to get to the next valuation event, and just enough. You don't want to be those safes that I was just telling you about where somebody gave away too much of their company and didn't even realize it. So how much is that? Well, you tell me. How much does it take to prove your concept? How much does it take to get traction, meaning revenue usually, or at least get customers, even if it's not EBITDA or revenue? Usually, and how much and what will that next valuation be? Here's a rule of thumb for you. Here's where I start. I say your next valuation event, you want it to be 2 times what your last one was, and you want it to be 1 to 2 years away. You want enough money to get you about a year out. If it's less than that, you're going to spend all your time fundraising and not building a company. If it's more than 2 years out, you've taken too much money, you've given away too much of your company. And you want that valuation event to double your value. You want it to be a big bang enough event to double your valuation. That's my rule of thumb. What you don't want to do, and now think about that and back into that. That means you don't go out with too high valuation too early, even if you find an investor silly enough to invest in you at that valuation, because you do not want to do a down round. You don't want to do a down round. And there are 3 reasons for that. Number one, it sends a really bad signal to the market if you've raised money at one valuation and did a later round at a second valuation. Okay. Number two, there's going to be anti-dilution protection in your financings, and you're going to bear some of that anti-dilution. You're going to bear some of the dilution. You're going to get hurt by this if you do a down round. And number 3, this is math. If we had 20 or 30 extra minutes, I'd go through it with you. But mathematically, I promise you this is true because I've done these calculations over and over. You are way worse as a founder doing a round at this value now and then doing a down round later because of the anti-dilution than you are if you just done 2 rounds at the same valuation. It hurts you more because you get beat up by anti-dilution. I'm going to leave it at that. If anyone wants to see that, I'm sure I've got a video about it someplace online. The pitch deck, I don't want to spend a lot of time on this. Rob has excellent speakers come in and do entire hours on how to put together an awesome pitch deck. I'm not one of the people that can tell you how to do that. What I will tell you to do is don't put your valuation in it, okay? Everybody wants to do that right at the end. Don't do it. Don't do it. I'm telling you, the VCs are going to look at that. And whatever number you put in your pitch deck, they're going to cut that in half, and that's their opening offer, assuming you put a real valuation in. It sends the wrong signal. Enough said about that. What I like to talk more about is the executive summary, because that's what I really work from. This is a template that I use, just the facts, ma'am. Most VCs, they get so many pitch decks. Do you think they have time to read those pitch decks, especially the ones with the big graphics and, you got to print them out, you got to flip through them? I'd rather have a 1-page executive summary, maybe 2 pages. Just tell me, just who's your team? Remember we talked last time about how important a team is? Who's your team, right? What do you think you're going to do in this business? How big is this market? Remember how important it is to get a big market? And do you have intellectual property? How are you going to keep other people from doing what you want to do? And then we can drill down into some more details in the little text box there. You have current investors. You got any big names on there? Anybody we might know? Any celebrity angels? What are you going to use your funds for? I wouldn't worry much about that. We all know what you're going to use it for. You're going to build out the technology and build market share. I'd want to know more about just where you are at this point, especially who's invested in the company and how far have you gotten, and what's next? How far can it go? All right, finally, term sheets with 15 minutes left. Don't get hung up on valuation, but that'll be the first thing that'll be in your term sheet. The VC is going to give you a term sheet. You're going to have the second, maybe third meeting, probably by Zoom these days. And they're going to make an offer, right? They're going to tell you what you're worth. And the way they're going to do it, how are they going to do it? What do you think? Well, I have calculated in the many years that I've been doing this, 30 different ways. I'm not kidding. I've got a whole memo on it if you want me put my LinkedIn contact in the chat box. I'll send it to you. 30 different ways, at least, that I've seen investors value companies. They range from the spectacularly complex, sophisticated, my God, that guy's IQ must be 100 to come up with that, to the very simple, just okay, I need 20% of your company, you need $2 million, you're worth $10 million, and everything in between. So the VC is going to use whatever method they use, and they're going to value your company, and they're going to give you a valuation. It's going to be in a term sheet. Now, if they don't, because sometimes they don't, if they come back to you and they say, hey, pal, what do you think you're worth? Well, you should do two things. First, you should go watch one of my videos on negotiation tactics, so you can figure out how to manage that process. And number two, you should start putting together a spreadsheet. You should pick 3 of my 30 methods that converge on one number, put that in a spreadsheet, give them a very, just a beautiful Excel with graphics and charts and graphs and different colors that shows how these 3 methods all converge on one value. So that must be God's honest truth. If they give you an opportunity to prove it, by God, you should prove it. Use 3 methods, converge on one, show them how you got there, and then prepare to negotiate from that number. And if you're wondering how you get there, like I say, there's tons of different ways. You might even consult a valuation professional on something like this. Although honestly, I rarely see startup companies do that. It's more gut than it is science. All right, I don't want to get hung up on valuation, because valuation is not your biggest issue, believe it or not. Valuation is not the most important thing in a term sheet. There are so many other terms. And I got lots of war stories about this, where somebody took the high valuation over the other term sheet that had a lower valuation, but more fair terms, and they ended up losing their company. So don't let that be you. Look at to be holistic about it, right? Look at the whole term sheet. What else is going to be in that term sheet that's really important? Participation and liquidation preference. What's participation? So let me explain this. Participation means that participating preferred means that the preferred stock shares in the proceeds of a sale, pro rata, percentage. A participating preferred will return its investment, and then it'll share in the proceeds of the sale. So more valuable the company, the more the preferred stock gets back. They participate. They take a percentage. Non-participating preferred, they just get their money back. Non-participating convertible preferred, they get their money back, or they convert into a percentage. So I invested my 10 million at an 8 million pre, so I've got 9 million pre, so I got 10% of the company. So if the company sells for 20 million, I'm going to convert. I'm going to take 10% of 20 million. It's 2 million. It's more than the 1 million I put in. The 1 million I put in is what I would get if I didn't convert. That's non-participating convertible preferred. I know I said that fast, but I'm going to send you the video so you can watch that again. The idea is that they either get their money back or they get a percentage. Participation can, and by the way, almost always, well, most of the time we do non-participating convertible preferred at Series A. It's just very investor friendly. And yes, I will send you my memo on evaluation methods if you will shoot me an email, and I'll leave my credentials, or I'll leave my contact information in the chat before I go. Now, participation can be capped, and it usually is if it's participating preferred. It used to be that way, but it is right now. It might not be that way in 2021, but it's capped. In other words, okay, Mr. Preferred stockholder, you get your $1 million back first that you invested. Then you get 10% of the company because you're participating on top of your $1 million, but you got to stop once you get 3 times your money back, because I mean, come on, 3 times your money, or 5 times, or whatever it is. And then the rest of it goes to the common. That's cap participation. And then there's conversion to common. Put a pin in this. I'm going to come back to this later. God, I hope I only got 10 minutes. Troubled companies, this is super important, because I'm going to talk about it now. We may not get to it, but it will also convert to, so what's the difference? Preferred stock gets their money back first, and then the common gets paid. Common stock, they just share pro rata in a percentage of the company based on their pro rata ownership. When does it convert to common? It converts on IPO when you go public. It converts on certain other events. Most importantly, it converts when a majority of the preferred stockholders vote to convert. Why would they ever do that? Why would they ever do that? They got preferred, you had preferred, and now you convert it, and now you got common. It's like playing golf. You had the ball, then you hit it, and now you got to go chase the ball. Why would they do that? Why would they convert? They would convert in a troubled company when they need to recap the company, when you need to make room for a whole new class of preferred stockholders. And there's always going to be that one guy out there that won't do it. So that's why it's a majority vote that converts them. That's one scenario among many. Dividends. Preferred stock will have a dividend preference. That means they get their dividends before the common stock does. Almost always in venture capital land, it's when, as, and if declared. It's non-cumulative. In 30 years, I've never seen a startup company pay a dividend. So let's move on. Liquidation preference. Who gets paid first? Here's a hint. The preferred stock does. Okay, we already did this example. I'm not going to waste time on it again, or spend time on it, not waste time on it. No time with me is wasted, but I'm not going to go over it again. You can watch this later. Board representation. Think about a term sheet as being two things. It's going to be ownership and it's going to be control. We're going to move. I just talked about ownership, liquidation preference, valuation, participation. Now I'm going to talk about control, board representation. How big is your board? Who's going to be on the board? Usually what you want to have at Series A, the first time you see a VC, is a 3-member board. You want the founder to have 1 seat. You'd love the common to have 2 seats and the VC to have 1. VC only gets 1. Founder gets 1. The battle's over who gets that third. It's either going to be you, the founder, or you'll get together and you'll select somebody who's an industry luminary. If he's a friend of the founder, it's a founder-friendly board. If it's a friend of the VC, then maybe not so much. Board rights. This is a little arcane, but yeah, you're going to have D&O insurance. Trust me on that. Not a VC in the world is going to sit on a board these days, especially not here in California when there's guys like me walking around. By the way, it's not guys like me. I'm a happy lawyer. I'm a happy event lawyer. I build companies, but there's guys like them that want to sue you walking around. You're going to want insurance and you're going to want the company to indemnify the venture capitalists. This can be kind of tricky, by the way, because the VC also has indemnity and insurance from his fund. Now he's got indemnity insurance from the company. It's not as slam dunk easy as you might think. Protective provisions, again, control issue. This is the idea that the VCs are going to make you come get their permission before you do certain things. There are standard provisions, and then there's the stuff we negotiate over. So usually all the traction here comes under that other category. Gee, I'm already on your, you're already on my board. Do I really got to come and ask you, Mr. Investor, for permission to increase the option plan when the board has to approve it? Stuff like that. Information rights, financial statements, other information, registration rights. I'm not going to spend much time on this. Just expect to see. VCs ask for them. They're like Miranda rights. People don't understand them, but they know they got them. Darn it. And they're going to ask for them. Again, I have seen lawyers negotiate over this. And yeah, I mean, it's kind of fun to play with, but I could do 10 minutes on why they're just not that important. We talked about co-sale and drag along rights. I'm not going to talk about it again. We talked about founder vesting. I won't talk about that again. Pro rata. That's the right to maintain or the right to participate. And your investor is going to want to have a right to participate in a later round. So you're really successful, you're going to do a later round. You can go ahead and you can put your money in. So they'll always ask for this. This will always be there. Your angels will ask for this if they're smart at all. A pro rata right or a right to maintain is actually pretty common now. And I think it's a little harsh to deny that to somebody who's willing to bet on you at an early stage. The only tricky part is if everybody's got pro rata and you don't really remember what I said about raising money for the next round. That applies from Series A to Series B too. Everybody's got pro rata rights. It might, might limit how many new investors you can take into the company. Option plans we talked about. I want to talk about redemption rights. Because this pops up from time to time. And a redemption right is a feature of preferred stock, usually not early, but maybe later, where the investor has a right to force the company to buy their stock back. Right? Why would they do that? Right? And it's after a period of time. Look, we've been in the fund 4 years. My fund's got a 10-year life and I'm already 6 years into the fund. So I need to be out of this thing in the next 4 years. So 4 years, if something hasn't happened, you got to buy my stock back. Basically, that's it. It's more complicated than that, but that's the idea. As a practical matter, think about this. If your company's doing well, the investor is not going to exercise their redemption right. They're going to hang in there. And even if their fund's coming to an end, they're going to distribute the shares out to their shareholders and let them hang in there. If the company's not doing well, that's when they would exercise a redemption right. And that's kind of like going to get a loan at the bank. When you need the money is when you can't get the money. You're not going to have the money to pay the redemption right. You're going to have to sell the company. So that effectively is how I look at that. That's what that is. It's disguised. Anti-dilution, don't do full ratchet. I've got war stories about that. I'll tell you about it if I had more than 4 minutes left. Don't do full ratchet. You rarely see that. Full ratchet means that if I put my money in at a certain valuation today and you do a later financing at a lower valuation, you have to reprice my round as if it were the lower valuation. That is really harsh. That's really harsh. Here, I'll tell you a secret. It gets even worse. I've seen deals that have multiples of full ratchet. In other words, if the value goes down, I not only get in at that lower value, I get in at a discount to that lower value. So I have an up round no matter what. That's going to eat away your founder's equity in a hurry. Exclusivity. Plan on signing a no-shop, right? What does that mean? That means once you sign a term sheet with a VC, you can't go out and talk to anybody else for a period of time. 30, 60, 90 days, we'll say. 90 days, you can't talk to anybody. That gives you guys time to negotiate a deal. If you can't get a deal done after that time, yeah, well, okay, then it was never meant to be. By the way, there's a subtlety here. Your term sheet, there's some, as usual, it's California. You have to guess. There's some law here that might not be apparent to anybody who otherwise reads good English. But you might have a letter of intent or a term sheet that says, look, this is totally non-binding, totally non-binding. You can't hold me to this. I can change my mind. I can walk away. It's non-binding. It says right there in the term sheet. Well, the California court might say, not so fast. We think some of that part's binding. Your confidentiality clause is certainly binding. The no-shop certainly binding. You know what else is binding? Your obligation to act in good faith. That's binding. And if you just change your mind and walk away because you've been negotiating with somebody else under the table, well, that's not really good faith. So how do we get around that? We put an expiration date on any term sheet or letter of intent. All right, we've gotten through our first round, or we're gotten through our first term sheet almost. We had a plan for later rounds. Here's some things to watch out for. It might be counterintuitive. Overly favorable terms. You as a company should always use this against an overly aggressive VC. When they say, hey, I demand that full ratchet protection, you say, look, if I give it to you, I got to give it to the next guy. And that's going to hurt you a whole lot more than it hurts me, right? You want to do some valuation planning. We talked about that. You don't want to have to do a reverse split. What does that mean? That means you are like super optimistic at the front end. Instead of authorizing 10 million shares, you authorized 100 million. And you set your option price at a 100th% instead of at 10 cents, or whatever you did that makes you out of market. Now you got to do a reverse split to bring your share numbers down to where your share price is high enough so you look fairly reasonable. You don't want to do a reverse split. It tells the world that you screwed up, that you didn't hit your targets, you weren't who you thought you were. Cap table management we talked about. And of course, that game we play here in Silicon Valley called Fire the CEO. Just expect that to happen. Expect that to happen and be prepared for it. Okay. We're not going to get into corporate venture capital. It is venture capital, but only it's corporations instead of financial investors. That's a whole lot different than financial venture capital. We'll do a whole presentation on that. Suffice it to say, it's got its pluses and minuses. We're not going to get into troubled company terms. We did this about a month ago. You can find it online. Instead, what we are going to do is I'm going to turn this back to Rob and say thank you for listening. I'm not going to turn it back to Rob. First, I'm going to take some questions. So let me go back to... Sorry, I'm juggling a lot here. All right, let me go to my Q&A, see if we got some questions. Okay, one question is what happens if a company takes money from an investor hold on here. I should be stop share. All right. Company takes money from an investor. There we go. And never signs a convertible note, never signs a safe, never signs a stock certificate, never signs any sort of security. Oh, I got bad news for you. You've just violated the securities laws. You better go paper that deal with your investor, and you better do it quickly. Because in the sale of securities, I used to have a partner, a fellow named Paul. I hope he's watching tonight. We're Facebook friends, even though I don't like his politics. But he used to say in securities, it's seller beware. It's seller beware. So if you didn't get paper from your investor, seller beware. It's your word against theirs. What did you promise the guy? What did you say you were going to give to him? Plus, I think you might have violated securities laws. You might not have done adequate disclosure. How could you? You didn't give them any paper. You didn't even tell them what you were selling them. Now, not many investors are going to, come after you that way until things go sour. So go paper that deal. Paper that deal tonight. You might even have to do what we call a rescission offer. What's a rescission offer? I do these regularly. Unfortunately, it's not a happy thing, but there's a way to fix that. Suppose you go to paper it, you can't paper it. The investor says, my word is my bond. I do business on a handshake. I'm offended that you would ask me to sign something. Believe it or not, I've gotten that. Usually they're not offended. They just know they got me. So what happens if that happens? Well, what's a rescission offer? Rescission offer is you go to the investor and you say, I rescind. You can have your money back. Oops, I screwed up. I didn't give you a document. I didn't get your signature. My bad. Here's your money back. And if you don't take your money back, this is what you're getting. This is the security you're getting, right? So either sign here or you get your money back. That's a rescission offer. There's a whole lot more detail and technicalities behind that, obviously, but generally, you can't be cute once you do that. You do have to make full disclosure at that point. You really need to put a PPM together, but that ought to work. It certainly works for federal law. Depends on the state, probably works for state law as well, although some states have their own particular rules around that. Now, why am I spending so much time on this? Because this happens way more than you think. And usually it's not a big deal. We just paper it at some point down the road and we fix everything and everybody is happy and they go off into the sunset. Remember what I said? I'm a happy lawyer. I'm not one of those tear company down lawyers. I did have a client that did not have such a happy ending who did this because he didn't have enough paper. He just kept it all in his head. Unfortunately, it was a cannabis company and he had it wrong. And turned out he ended up doing the Bugsy Siegel deal. You know what the Bugsy Siegel deal is? The Stardust Casino. He sold about 150% of his company, according to the investors who had no paper. And when he finally did sit down with a lawyer and do the numbers and make that realization, he went back to his investors and he said, you're going to laugh. You're going to laugh. The funniest thing, this is so funny. Actually, you don't have 10% of the company, you got 5. They didn't laugh. They didn't think it was funny. They not only sued him, they went to the criminal authorities, the Department of Corporations of California, and that individual went to jail. Yes, jail for what was, I swear to God, an innocent mistake. He did not spend all the money on ganja. He did not take a trip to Bermuda. He put it all into a software product. And that's what happened. This is serious stuff. Serious stuff. You can't sell securities without a lawyer. You just can't do it. I know you can go online, you can download the forms, you can pretend there's no state or federal filing requirements, and close one eye and look the other way and hope the SEC doesn't catch up with you. And usually you're right, but when they do, my friends, it is ugly. All right, enough of that. Your company is doing well, you want to raise additional money, but the angel investor took a humongous, you said big equity stake, I'm going to say humongous stake because that's what it looks like now. How willing are they going to be to dilute their shares because the company, the value of the company should be greater overall? Well, the answer is that's why you got to be very careful when you choose your angels. And we went through this 2 weeks ago, right? Remember what I said? Be careful. Be careful who you take money from because you're stuck with them. And the tough conversation you have to have now, and I've seen this over and over and over again, is, look, you got 50% of my company and the VCs won't invest in it. There's not enough left for the founding team. There's not enough shares to incentivize them. So you can either have 50% of nothing, or you can have 25% of something. Now, I've represented investors who I've talked into doing that, that are very reasonable people. And I've represented companies that could not sell that deal because now the investor's mad. How dare you, ask me to dilute my shares? So it depends on your angel, but sometimes that's what you have to do in order to survive. If you want to live to fight another day. And by the way, that's a strategy. I mean, I've heard companies go into that with a strategy. They give the angel whatever they want, just knowing they're going to blame the VC for what they're going to do to the angel. That's the flip side of this story, right? So the founder side, the company's viewpoint is, God, an unreasonable angel. He's got to do this. What's he trying to do? Kill the golden goose? We're going to change the world, right? And he won't dilute. What a jerk. The angel's viewpoint is that, can you believe that founder? He played me. He knew I wasn't going to end up with this much stock. He knew that he was just going to use the VC as an excuse to give me less than what I was promised. That's the dilemma. That's the argument you're going to have. So that's why I say, get your spreadsheet out. If you're going to sell those safes, plan into it, do some strategizing, figure out where you're going to be and make sure you're not going to hurt yourself. Is it of great value to have a lawyer as a co-founder? That's not a joke. Why would I think that's a joke? I don't think it matters. I've co-founded companies. They didn't go that well, to be honest with you. In fact, I remember sitting in a conference room on Sand Hill Road, and the VC just looked at me and he looked at my bio and he says, "Wait a minute," he says, "you're just a lawyer. What are you doing here as a co-founder?" And then I just put my tail between my legs and slinked on out. But no, it depends. I mean, is like any other co-founder, are they bringing something to the table? Are they bringing expertise? Are they bringing connections? Are they bringing domain expertise? If it's a legal tech company, then it makes a lot of sense to have a co-founder, a lawyer as a co-founder. Or if it's something else where they can actually add some value, then it makes a lot of sense. The only difficulty, the risk here is that it's exceedingly difficult for somebody to be a lawyer and a business person at the same time. Just exceedingly. I know that doesn't sound like it should be, but I've tried. It's just so hard. It's just so hard. You got to put a different hat on. You got to look at things differently. One way you're looking at the upside, that's what founders do. You're wild-eyed, starry dreamers. You're always focused on the upside. And as lawyers, you got to be focused on the downside and how to protect it. Very difficult to do. I heard a psychologist say it's like really hard to hold two thoughts in your head at the same time. Come to my negotiation seminar. You'll hear all about it. Well, that's it. If you're a co-founder, if you're a business person and a lawyer, you're trying to hold two thoughts, opposing thoughts in your head at the same time. All right. Market size is top down. Don't investors want to see bottom-up revenues estimation? Not in my experience. Not in my experience. Revenues is not that big a deal. What they want to see is value, right? They want to see value. They want to know that there's, if you were here 2 weeks ago, we talked about it. Now, revenue might be an indicator of that. Don't get me wrong, but we want to see a company that has enormous potential and is going to grow it's going to grow into something really big. And this, not to be cynical, but to be practical, you don't have revenues anyway. You're just a startup. So I wouldn't focus on that if I were you. Play to your strengths. You read the book Strength Finders, play to your strengths. Your strength is not that revenue you don't have, but you will someday. The strength is how humongous the market is and how when you do get your revenues, it's going to be huge as well. How much time do you have to exercise the option and buy the shares? According to the ROFR. So you've actually asked about 3 different questions there. So option exercise, like I say, it's either 30 or 90 is usually the standard from after your employment terminates that you can exercise the option and buy the shares. Look at your option agreement. If it's an ISO, incentive stock option, it'll be 90. By statute, if it's an NSO, it might be 30 because they can get away with it. I think that's what you mean. Then you say according to the ROFR, and that's just negotiated. In other words, and that's going to be a very short window. In other words, you've got a buyer on the line. You give the company notice. They have a much shorter window typically in order to exercise their right of first refusal. Oh, here's a good one. For an employee, which is better, RSUs or preferred shares? And the answer is neither. For an employee, You want stock options or stock or restricted stock. You do not want restricted stock units. You do not want preferred shares. Why not? I'll tell you why. First of all, preferred shares are worth more. There's a lot of reasons. So number one, I'm going to give you my three reasons again and try to remember the third. Number one, preferred shares are worth more than common shares. So if someone gives you preferred shares, you have a taxable event. And it's going to be more tax because you have more value than if they had given you common shares for services. Number two, and not everybody knows this, but as a tax matter, a stock option on common stock is not subject to this nasty statute we call 409A. It's not deferred compensation. As long as that option is exercisable for common stock, that exception does not exist for options on preferred stock. So once in a while, we see somebody who, goes off the reservation and creates an option plan for preferred stock. Doesn't work as a tax matter. I know that's counterintuitive and everybody's disagreeing with me. Go look it up, promise you. So those are the two of my big three reasons you don't want to have preferred shares for an employee. You're going to have more income. You're going to have, you can't have an option on preferred. And I guess the third reason is that the VCs, I don't think they want you running around with their preferred rights and preferences anyway. That's for the financial investors. The RSU. So what's an RSU? That's a restricted stock unit. You've heard about this. Some companies do this. Some big public companies, famous Silicon Valley companies do this. And that's where you give somebody the right to grant a stock at a later date. That works super well if that stock they're going to get at a later date is publicly traded stock. Because when they get the stock or when they vest, so you vest in the RSU, that means you get the stock. When you get the stock, you're taxed on the value of the stock. You're a service provider. If that company is public, you turn around, you sell the stock into the public markets and you get cash and you pay your tax and you take the difference. And everybody's happy, and then you can buy your place in Nevada and you don't have to live in San Francisco anymore. If that's a private company, here's how it plays out. Your RSU vests, you get the stock, you have a big tax event, you go to sell your stock and you can't because nobody wants to buy it. There's no market for it. So now you've got this stock that might go down in value, by the way, and you got this big tax bill. You don't have any cash and you're stuck in San Francisco a little longer. So that's why you don't want RSUs. They're fun to talk about, and if you're a public company or about to go public, we'll do it, but otherwise, rarely. Holy cow, what happens with a foreign investment in CFIUS? Does everyone know what CFIUS is? Okay, sit back, we're gonna have a little history lesson. The Committee on Foreign Assets, something or other. Anyway, CFIUS is the committee that reports to the president, theoretically, and they have the right to approve or disapprove acquisitions and investments by foreign companies into U.S. companies, by foreigners into U.S. companies. Now, up until a couple of years ago, companies could voluntarily report and say, hey, we're taking this money into our company, so here's our report. And then CFIUS has a certain amount of time to either block the deal and say, no, we won't approve it. It's an antitrust provision in effect, or to not say anything, in which case they could then close their deal. And they would only have to report if it were sensitive, critical technology. So another statute came along a couple of years ago called FIRMA. I don't even remember what it stands for, but it's an extension of CFIUS, and it makes that reporting mandatory now. It expands the kinds of companies that have to report. It's no longer just critical technologies. It's also anything that could be subject to certain export control laws. And it blocks and it holds up almost every deal I do where there's foreign money coming into a U.S. company. Every M&A, if it's a foreign acquirer, and almost every foreign investment. We have to jump through the hoops, determine whether we're required to report under CFIUS because of FIRMA, and secondly, whether we want to. Now, I know what you're thinking. You're thinking, well, look, I don't make, weapons, right? And I don't make chips, and I don't make spy planes. And tell you, there's some other ideas I could tell you about that are even further out, but I won't. But I don't make any of that sensitive stuff. So what do I care, right? what do I care? That's what you're thinking. Well, you do care because FIRMA has expanded. FIRMA has expanded CFIUS to include not only these really sensitive technologies, but it's a whole much wider category than that. And it also includes, here's one that'll surprise you, it includes data. So you're a company, you have a lot of data on a lot of people. Federal government might not think it's really in the national interest for a foreign company, maybe depending on what country they're from, to have access to all of that US data, right? So you have to report that. That's a reportable transaction, and they might block it. So we have to go report and then see what happens. Oh, excuse me. Long day, been talking all day. All right, let me go down to, I know there are a few more questions here that came in early on. Okay. All righty, well, I'm going to talk a little bit. Oh, here's a question. Somebody asked me about troubled companies. They want to know if everything I just said applies now that we're going into a recession to troubled companies. Well, that's a whole presentation. That's a whole hour plus a half hour of questions. But let me tell you what I think is what you're going to see coming up. And in fact, I'm going to go back to my slides for a second because we didn't really get to this, but I do think it's important. And thank you for that brilliant question. So let's talk a little bit about troubled companies. You should be looking at a screen. Where's my chat? You should be looking at a screen. There we go. That says troubled company terms. So here's the difference with, and by troubled company, I mean people have put money into you. You had high expectations. You thought things were going to go really well, but it just didn't turn. Things didn't go as planned. We had a recession, maybe, kind of like we did in 2008. Maybe maybe the government forced every business in the country to shut down for 6 months or something like that. That caused your company to not do well. And you didn't hit your revenue numbers, your valuation isn't what you hoped. The VCs are really unhappy with you and you need more money and they don't want to walk away from their investment with nothing. So they're going to go ahead and negotiate. Those are troubled company terms. All right. What's going to happen? Okay, remember when I talked about that mandatory conversion to common? Remember I said earlier, geez, you got preferred, there's also a mandatory conversion. A majority of the preferred can get together and they can force all the preferred to convert to common. They give up all their preferences. You know, why would we do that? Why would anybody do that? That's crazy. That's crazy talk. Okay, this is why you might do that. That's a recap, right? We're going to recap the company. We're going to force all the preferred to convert to common, give up its preferences. Now we've got a company that's more attractive to a later investor because what's going to happen, the later investor is going to come in and they're going to have a preference not only prior to everybody else, because they're going to get that anyway, by the way. Just keep that in mind. That's always negotiated. And the latest money in, if anybody has a preference, usually, not always, sometimes it's just pro rata, but usually the latest money in gets their money out first. What's different if we convert everyone to common? Now you, the early venture capitalists, are not standing in front of the founders. So when we sell the company, yes, the later investor, they get their money back first. Okay, fine, we can live with that. But then what's left over gets split up pro rata among the early investors and the early founders and service providers. Why is that important? Because yeah, those early investors are important. They put money in the company. Thank you very much. But those founders are super important. They got to get you to liquidity. Who else is going to come in and live on top ramen for another year to get you to liquidity? So they got to stick around. This is why we do a recap. That's a troubled company term. You're going to see that. Here's another troubled company term. Full ratchet. We talked about that. We talked about full ratchet dilution was. If we do hit a deeper recession, as some people say we're going to, haven't seen it yet personally, but By the way, we went over this 2 weeks ago. The venture market's strong. You know, it's doing well. It's not as strong as a year ago at this time, but it's still strong. But if we do hit those bad times, you're going to start seeing stuff like full ratchet. That means, look, you got no choice. I'm your only investor. I'm your only option. You got to take whatever I give you. Not only do I want to convert everybody before me to common, so that I, make sure the founders will stick around. I want full ratchet anti-dilution. That means that if we go out and raise money later, even if it's from me, even if I give you more money down the road at a lower valuation because I've beaten you up even more, you have to reprice the money that I'm putting in now at a lower valuation. That's full ratchet. You don't think that happens? You have not lived. I have seen VCs. Where's my shark picture? I should put that back up. I've seen VCs completely take a company away by putting in full ratchet and then doing down rounds with their own money. So it happens. It's really ugly. Stay away from it if you can. If you can't, at least get the Excel out, start doing the spreadsheets so you know just how bad it can get. Uncapped participating preferred. I haven't seen that in a long time. That's the idea that the investor gets their money back first, and then they share pro rata. Remember what I said? Usually we cap that, so they just, but uncapped participating means they just share and share and share with no cap on it. Insider rounds, low valuations, of course. They're going to get, they're going to put their own money in. Where this gets tricky is where there's an insider round that isn't properly shopped to the other VCs. That's when you get low valuations because you don't know it's an insider round. If you don't go out and shop the company, if you don't have a banker or something like that, or a valuation professional, you don't know if you're selling that stock at its true valuation. You might be selling it too low because it's an insider round. And your board of directors is by this time controlled by the VCs, so they're totally conflicted all over the place. Really risky, dangerous thing to do. The companies do it all the time. Down rounds, that's where the valuation goes down in the next round. Last down round, the last downturn we had, I went through several down rounds. In fact, every downturn. In fact, even when there's not a downturn, you're going to see down rounds. Companies do that. Remember what I said about anti-dilution protection. So there are protections in the investor documents that say, look, if you sell stock later for less, a lower valuation than what I bought in at, you're going to give me some extra shares. And we do that through the adjustment to the conversion privilege. Or in other words, my preferred stock will convert into more common stock down the road. That's generally the mechanism. You don't need to know that much detail, but suffice it to say there's protection for investors for down rounds. They almost always waive that. You just have to, right? You just have to, because otherwise they're going to end up with, again, the founders don't have enough common, and the new investors, they want to incentivize the founders. They don't need to incentivize the early investors anymore. Pay to play. These are the provisions that will be in the documents that say, look, existing investors, if we need more money down the road, you guys are going to have to pony up. You're going to have to participate in that on a pro rata basis. If you don't, you're going to lose some of your rights. We're going to convert your preferred to common. You're going to lose your voting rights, stuff like that. That's what that is. Those are troubled company terms. While I'm at it, I want to talk about successful terms. What's a successful VC investment? Well, that's an exit. And what's a successful exit? Well, that's an IPO, kind of rare these days, at least in my world, or a sale or acquisition, right? That's what we're all looking for. Those are successful exits. I think we do a whole hour on successful exits, so I'm not going to get into that. What I am going to get into, sorry to be Debbie Downer, but let's talk about unsuccessful exits. So what happens if you can't do a down round? You can't do any round, no matter what kind of terms you offer the VC. What happens if you get to the end of the line and you've got creditors lined up, you've got taxes that are unpaid, you've got lawsuits, right? You got employees that haven't been paid. All right, what happens in that scenario? I want to talk a little bit about that. I hate to do it, but you know, you need to hear this because you need to know how to prepare yourself in case things don't go wrong, don't go well, because you want to live to fight another day, right? Not every company is going to be successful. Not every one of the companies you found will be successful. Maybe they will, but odds are they won't. So you just want to make sure you don't ruin your life with that first one that didn't do well, or the third one, the one that didn't do well. And I got to tell you, there's lots and lots of stories of successful founders that say, yes, I founded 4 companies, 3 of them failed, and 1 made me rich. Right? Well, they were very smart in that the 3 that failed didn't drag them down with it. Here's your issues. Number 1, taxes, right? Employment taxes in particular. In California in particular, once the company starts to go downhill, management, the temptation is almost irresistible for management to use money that's set aside in a trust fund to pay employment taxes to keep them alive a little longer, pay a little more salary, to, I don't know, to pay a hosting service, to do whatever it does to keep the doors open a little longer because you're just so close to getting that next round. You have personal liability for that, Mr. Founder. You have personal liability for that. Pretty much everybody who was a responsible person. Your board might even have some liability, depending on how active your board is. Your bookkeeper could have liability. You think I'm kidding? There's cases here in California. Our EDD will regularly go after bookkeepers, you know, because they should have done something. So you do not want to stiff the government on taxes. That's one that'll follow you the rest of your life, or at least till you can bankrupt it, which is a good 3 years out. Secondly, employment. You might not know this, but in California, you could have personal liability for knowingly, you know, getting somebody to work when you can't pay them. So you might have personal liability for employment claims. Don't let that happen. Fiduciary claims. If you did anything wrong, you might have to worry about that happening. Now you're protected by what we call the business judgment rule, usually, but there's exceptions to that. You need counsel on this. You want to make sure you're not going to get sued. And here's the tricky part. Not only can your shareholders sue you, now once you're insolvent, your creditors can sue you for fiduciary claims. In other words, you didn't do enough to look after their interests. Securities law claims. People are going to be combing through your documents really carefully once this happens to see if they can tag you personally, Mr. Founder, under the securities laws if something goes wrong. And on that, check your contracts. What did you agree to guarantee? What did you agree to pay? Did you guarantee the lease? You know, can you get out of it? Can you negotiate your way out of it? And then finally, what we call piercing the veil and creditor claims. 2 things about that. Piercing the veil, you hear about that a lot. In my career, I figured this out once. I've formed thousands, maybe 10,000 companies, just thousands. I've been doing this a long time. I'm extremely old. Most of those companies have failed because I do startups. That's just statistically, most of them are going to fail. They're not going to have a successful exit. A lot of them are going to get sued when they fail. Creditors are going to be really unhappy. They're going to come chasing the company. Almost always, they're going to claim to be able to pierce the veil. They're going to get a litigator who's going to say, I litigate these for a living, I'm going to pierce the veil. In the thousands of companies that I've formed, never once has that happened. Never once has somebody pierced the veil because we set those companies up correctly, right? Observe formalities, we don't commingle funds. And here's the number 1 most important thing, you know, they're going to follow the money. You know, the money goes where it should go. You know, we're not using it as an incorporated pocketbook. You set your company up carefully, you can sleep easy at night, even when you get those nasty letters from the litigators. Secondly, creditor claims. Here's the way they get you. Creditors are going to say, look, not only does the company owe me money, but you, the founder, owe me money because you know what? You defrauded me. You told me that you were doing great and you weren't, and you knew you couldn't pay me, and you had no intention of paying me, and therefore I'm going to sue you for fraud. Yeah, don't let that happen to you. It's the answer. Okay, with that, we have gone through all of our questions. I'm going to turn this back over to Rob.
There was a request to see the shark again.
Oh, Okay, well, hold on here. You
Right.
want to see it?
Yeah, sure.
A request to see the shark, but you don't want to look at me. You want to look at the shark. All right, hold on here. I don't know. He might have swam away. I might have scared him off with that last slide about what happens when you mess with me. Oh,
There it
there
is.
he is. Oops.
Cool, leave it there. Well, anyway, I want to thank Roger for spending time with us, sharing his expertise, his enthusiasm, and his sense of humor. I want to thank the audience for tuning in and asking great questions. See you next time.